Hello, good afternoon, and welcome to our Wealth Wednesday. My name is Jody, and I am the adult programmer at the Fredericksburg branch of the Central Rappahannock Regional Library. It is my honor today to introduce to you Lamont Brown, the owner and wealth manager of Alna Wealth Management, who is going to be talking to us today about our topic of step into retirement, what's changing and what's not. Lamont, if you would like to take it away.
Thank you, Jody. It was the first day of a new job. I showed up early and everything was going as planned. I was thinking and I was nervous and everything that I could think of was coming to my mind and I was flooded with the situation. Just like you, this was not the first time I'd been at a new job. This was not my first new job, but this one was different. I was walking into a situation where I had my dream job of being a United States Marine Corps platoon commander, and now I was going to be taking on more responsibility than I ever had. And it was at that point that it hit me. Things were definitely getting different. Fast forward 6 months, and it all came back to me. I could remember my first day just like it was yesterday, and it was at that point that it came to my understanding that not only did things change, but there was a lot of things that stayed the same that were consistent across every unit I showed up to. And it was those things that actually guided me through those first 6 months. Good afternoon, and today I'm going to talk to you and help you step into retirement first by understanding what's changing, but most importantly, understanding what's not changing. Because for many of us, we're thinking about retirement as this big line in the sand that we have to go across and everything's going to go up in smoke. It's not like that. And that's what we're going to talk about specifically today. What's changing? What's not, and then I'm going to end with a strategy that can help you get through all this. But before we start, let's start with the challenge next. For most of us, we've been doing the same thing for the last 20 or 30 years, and we've gotten pretty darn good at it. We show up to work, we get paid on time, everything happens just as it always has, and we've been diligent about saving and doing all those things that we need to do to prepare for this one day. But in one fell swoop, everything's changing. The rules are changing, the day is changing, your social connections are changing. All of these things are changing with this one time in your life called retirement. And we're going to talk about what is changing first. Next slide. Next. The first thing that changes for all of us is we go from one consistent paycheck when we know exactly when things are going to happen, first and 15th, the beginning of the month, the middle of the month, whenever you're getting paid, it goes from being this consistent thing to being many separate little checks. All is significant, but each one of them is different on date of delivery, on what to expect from it, and the planning around each one of them. So we go from one consistent paycheck to having things like Social Security to think about. Are we taking it early? Are we taking it at full retirement? Are we waiting until later? We then have to think about our pension. Well, are we taking spousal benefits? Or are we taking spousal benefits? Are we just doing it by ourselves? What are we doing? And then the extra added challenge is now our income depends on distributions, something we haven't done up to this point, but now we have to consider. So, change number one is our income. It goes from being one consistent thing to being many, some consistent and some not so consistent. Next, the next thing that changes is our investments. Before retirement, investments were pretty straightforward. We had one strategy and we just dropped as much money as we could into it on a monthly basis. We made sure it was consistent. And just like my clients, they're just like, oh, I'm increasing my contributions. I want to max them out each year and make sure. And for many of my clients, like Sue, she put away money for years at the same rate, consistently hitting those higher numbers and making sure she was doing it on a monthly basis. And then from there, it all changed. After retirement, now the bucket becomes leaky. I like to say, now you have to consider things like lifestyle. How much money do I need to take out to keep everything going as it's been going? Then I want to be thinking about what is being driven by the market, my required minimum distributions, and all these other things come into play because now I have to start planning for each and every one of these distributions, and my investments have to change. So, change number two is my investments. And then next, our next change is this one. This one is overwhelming and it can be a lot to take in, but you just have to put it in order and think through it. Prior to going into retirement, you got your traditional W 2 earnings. We all know what that is. We receive it every year. We know exactly what that number is. It's paid out on the 1st and 15th. We know how to plan for taxes there. But after retirement, what happens? Now we're dealing with ordinary income through distributions. We're having to deal with capital gains through investments. We got qualified and non qualified dividends. And we may even have tax free Roth contributions. So, all of that has changed the tax picture because now, with all these different things, each one of them comes with a different planning need, right? So, you have to start to think about all of this and how to pull it together. So, up to this point, we've talked about the three things that are changing. Our income is changing, our investments are going to change, and then our taxes are going to change. So let's get into what's staying the same. What can we really depend on? Next slide, please, Jody. All right, so what is staying the same? First thing, next. First and foremost, the need for diversification throughout your investment life and throughout your adult life. That has probably been the one thing that's been a constant for most people is don't put all your eggs in one basket. Make sure you're diversifying across different asset classes and keeping things in different places, right? That has been very consistent. The need for diversification is the same, but it's now a little bit different because now not only are you needing to diversify what type of things you hold, but you now have to start thinking about diversifying the purpose of the money that you hold. You're going to have money that you're going to need this year. You're going to have money that you're going to need next year. You're going to have money you're going to need 10 years from today. And then you're going to throw in money that you're trying to grow. And then you're going to throw in money you're trying to leave to those people left behind. All of those are going to create a different need for diversification. And so your allocation is also going to change because the money you need today is going to be different than the money you need 10 years from today. And then most importantly, you want to start thinking about tax location. When you're taking money out, the last thing you want to do is create a lot of things, a lot of taxes from those distributions, but maybe you have to. So the need for diversification is still there. It just now changed and gotten a little bit more complex, but you now have to plan for all these things. Is my money set up for the right purpose? Is the allocation correct for that purpose? Is the tax location exactly what I need because when I'm going to be actually taking this money out? So that's the number one thing that is going to be staying the same, the need for diversification. Next, the second thing that's going to be staying the same is discipline, discipline, discipline. This is the hallmark of the United States Marine Corps is discipline, making sure you do what needs to be done and do it the exact same way, regardless of your feelings. This is exactly the same thing that you've been doing so far. Up to this point, you've saved and you've done what you were supposed to do. You've saved consistently, you've reduced expenses consistently. That same level of energy is exactly what you're going to need to do when you start to retire, but it's going to be a little bit different. You're going to keep a consistent strategy. So there's your discipline. You're going to make sure that if you say, I'm going to only spend X amount of dollars, exactly that's what you need to do. And then where the discipline comes in is when we have those market downturns, which we all know are going to happen. And that's when you have to stay the course. This is a great illustration that shows the difference between someone who's in the market all the time and someone who's out for 1 week during the year, or someone who's out for a month during the year. And you can see the drastic difference between what happens if you stay the course and keep consistent and just ride out market downturns, and what happens when you get out. That is the same level of discipline you're going to need to carry into retirement. So the discipline that got you to where you are today is the exact same discipline, but you're going to apply it a little bit differently. You're going to stay consistent with your strategy, and you're going to stay the course. If you planned up to this point, you want to make sure you don't unravel your plan because of a market downturn, or a little because of being uncomfortable about the market. I know that's important, but stay the course. That's where discipline comes in. The next is that tax efficiency is always going to be a challenge, and it's something that you have to consider even more when you get into retirement. I don't know where I grabbed this quote from, but I think this is something that you need to really, really dig deep on. The only constant in life is death and taxes. And just like you're dealing with taxes right now, you're going to be dealing with taxes in retirement. But now it's going to be different, because now you're going to be thinking about, when I take money out, what is the tax impact of taking it from this account versus this account? What is the tax impact of having this investment versus this investment? And then to top it off, you're going to have to start thinking about this required distribution. Required distributions come about when you reach the age of require minimum distribution, depending on your age right now. And you're going to have to take money out regardless of if you need it or not to pay taxes on it. That can be a good thing if you're planning for it, or it can be a very bad thing if you haven't planned for it. So you want to be thinking about, what is it that I can do to shift that out or change it up in some kind of way so I'm not having to pay those taxes that way. And the way you do that is what we call conversions, and that is changing the tax treatment of something. So you're going from it being treated as an ordinary income to being possibly treated as tax-free if you do the process the correct way. So you want to be thinking about all of these things, and how am I going to reduce my long-term taxes, stay completely efficient as I go into retirement. So these are the things that you want to be thinking about. Next, please. So all of those things we've talked about so far, the things that are changing, the things that are staying the same, and now, what strategy should you have as you step into that new role of retirement? Next, please. First, know the gap. Your gap is the difference between what you're guaranteed to receive through Social Security, pensions, and other guaranteed source of income, and your actual need. When you know what that gap is, that is going to be the number that liberates you. I had a client come in and we did her analysis and everything like that. And she was just frazzled to no end, because she felt like she was in a place where it was going to be uncomfortable going into retirement. But then after we did the numbers and worked it all out, it came out that 90% of her need on an annual basis were being covered by guaranteed sources. So she was going to put less pressure on her 401k or thrift savings plan to withdraw. So you want to know what that gap is, because you may be closer than you thought you were, but you want to first understand what is the gap between your guaranteed income and your actual need. Next, you want to have a strategy. Back one slide, please. You want to have a strategy. That strategy is something you want to stick to. This is where the discipline comes in. You want to have a strategy for, am I taking 4% a year? Am I increasing that 4%? Or am I doing a bucket approach where I'm only taking from one place and I'm letting the other stuff grow? Or am I doing this dynamic thing where when the markets go up, I give myself a raise, when the markets go down, I take money back? You just have to come up with a strategy and know what your strategy is and keep to it. Having a strategy is not the hard part, or choosing a strategy is not the hard part. The hard part is sticking to it. And you really, really, really want to know what your strategy is and what you can depend on. No extravagant expenses. This is just dealing with lifestyle. Next, you want to plan for your required minimum distributions, because most people look at it like this thing that I have to do later on. But you should look at it like, oh, I'm going to have this income that now I'm going to get regardless if I want to or not. And you can plan around that. If you know you're going to get a required minimum distribution, you should be thinking about, okay, well, if I have to take out this money, even though I don't need it, well, let's plan for it, because you're not going to get away from it. So just prepare for it. And you always, as you're mastering your income, you want to be considering the tax impact of everything you do. So if you're taking money from a Roth IRA, what's the tax impact? If you're taking money from a traditional IRA, what's the tax impact? If you're taking it from, if you're receiving pension income, or all these things, you want to know what is the impact of everything that's coming into my household, because only by knowing that will you be able to make good, solid decisions. So after we master our income, what's number two? Next, plan your withdrawals. This is an ATM machine. You want to know what you need and when it will be available. So the way I'm looking at that is you look at it, if you say I need $50,000 to live on annually, and I'm going to need $50,000 this year, $53,000 the next year, $53,000 a year after that. You want to start to plan to make sure that money is available. The way you do that is by making sure your allocation is right and you know where you can expect that money to come from. The money that you need sooner needs to have a different allocation than the money you need later. So you want to be allocating based on your needs. And if you need it before 2 years, the market's probably not the best place, but that's something you need to consult your financial professional about. But you want to be thinking like that. If I need it within the next 2 years, I want to make sure that money's available. I want to make sure it's clear and I know exactly where it's coming from. And then you want to navigate the taxes. There's the RMD, required minimum distribution. You have IRMA, you have qualified charitable distributions. All of these things are things you need to be planning around and navigating as you start to withdraw money. The more you withdraw, the more taxes you pay. Just think of it that way. Next, and you want to invest your strategy. You want to update your investment strategy. One thing that most of us do, I haven't gotten there. What I see a lot is most people come into retirement with the same mindset that they had when they were accumulating. The interesting part is that strategy served them well during that period, and now there's the change. We have to start thinking about having not just one risk tolerance for our whole portfolio, but we should have different risk tolerance based on when we're going to use the money. You see the difference? So now we're looking at our risk tolerance based on I need money next 5 years, I need money the next 10 years, I need money the 10 years after that. Then I'm going to allocate and invest it appropriately. So we're going from having possibly a one size fits all strategy to having two, three, four strategies based on our specific needs. So we're going from one strategy to possibly many, which can increase the challenge with planning and doing all those things, but that's something that you want to be thinking about. And then you want to be aware of this one. It's called sequence of returns. This is one of the risks that retirees face. When you were working, you did one thing. You put money away and you didn't worry about the market or the changes in the market. You just kept buying and buying and buying. In this situation, you're taking money out. And if it happens to be one of those bad years and you continue to take money out at the same rate, you create a perfect storm for your portfolio, which can have a big impact on whether or not you're successful or not. So you want to know, am I creating a big impact on my portfolio if I take out during a down in the market? And how do I prevent that? How do I prepare for that? If you have questions about that, that is something that is very, very important to plan around and to consider as you're working through your plan. So, updating your investment strategy is number three. So we've talked about what changes, we've talked about what stays the same, and we've talked about all of the strategies except for the last one. Next slide, please. The last one is the most important one. Everyone who is preparing for retirement has done one thing and they've done it well. They put everything in. And a lot of times, not saying it's you, but a lot of times I talk to people who say, I haven't looked at my portfolio in a couple of months. And if that's you, that's completely normal. But when you're in retirement, it becomes different because now your portfolio is not just money where you place where you're putting money and hoping that it's there later on. It's money that you're probably going to need in the next 5 to 10 years. And you want to make sure you know what's going on. So you want to commit to ongoing review of your current situation and make sure you're making the appropriate adjustments. Couple of case in points. Social Security increases, Medicare increases. All those change your income. Taxes, tax changes and change your tax impact. Your investments, are they up? Are they down? You're going to be making adjustments based on all of these things. Insurance, you're going to possibly need more insurance. You're going to possibly not need insurance. There's a lot of things going on, and you want to be constantly reviewing at least on an annual basis. Estate plans, people that were in your estate that have passed away, or you changed your estate planning. All of those things are things you need to be doing on an annual basis, and you need to commit to that because in retirement, there's very little room for mistakes. Like when you're working and you're starting out and you're just like I did as a brand new first lieutenant, um, you want to make sure that you're putting as much effort into keeping everything on track. When you started out, you didn't really have to worry about it. You had 30 years ahead of you. Now you're going to be dependent on everything, and any small mistake can be very impactful. So you want to be making sure that everything is in order. Now, I brought up a lot of things during today, and I know it's not all clear for a lot, and because I talk to people every day, but I want to open it up. If you have any questions or you just want to reach out, I did have someone reach out a couple weeks ago. They were concerned about something we talked about, and they really wanted to understand a little bit more about it. Please don't hesitate. Reach out. My phone is always my phone always rings, and I'm always available via email if you have a question. Next slide. So take this, go use it, and I look forward to seeing you next month.
Thank you once again, Lamont, for joining us today and for all that insightfulness into what's hopefully going to make a lot of us think a lot deeper than we were before. Just before we leave today, if anyone has any questions, they feel free with sharing or asking on one of the platforms. Please do right now.
All right, we'll hang there for a couple minutes.
Yeah. And if not, again, Mr. Lamont's information is at the beginning of this presentation, and he has very generously offered to let you email or call him if you're with your questions. Mm-hmm. All right, so it does not look like we have any questions at this time being. Again, thank everyone for joining us today. And once again, thank you, Mr. Lamont Brown, for giving us this presentation.
Thank you. I'm looking forward to seeing you all next month.
All right. Have a great rest of your month, everyone, and happy holidays.
Happy holidays.